Good evening, students. I hope you have revised your last class. So what we are going to do today is we are going to again start with the depreciation where we ended in the last class. But before that, we will just quickly revise a few things so as to, make it a link. So what we were discussing in the last class was about section 32, as you could see on screen. So we were talking about the conditions for claiming the depreciation. What are the conditions? It should be owned by the assessee, and in case of hire purchase, if it is proved that the assessee at the end of the hire purchase tenure will have the right to purchase, then there is a CBDT circular on the same which allows the assessee to claim the depreciation, the one who is taking it on lease. Generally, lessee is not allowed, even if he is using the asset for his business, right? It's the lessor who is allowed, but in case of hire purchase, depreciation will be allowed if the asset will eventually be transferred. Also, there is another exception under explanation 1 to section 32, that if the building is not owned by the assessee, but he has incurred certain capital expenditure on the construction of that structure for renovation or extension of building, then the lessee will be entitled for the depreciation on the same. Second condition is that the asset should be used for the business or profession of the assessee. Even passive use will be entitled for the depreciation. Are we clear? So with this, we'll get started. Now, what is the second point? What we have written is, the second thing we have written over here is the basis for the depreciation, which is what we are going to discuss now. Basis for the depreciation. Okay. Now, we have under section 32, two parts. 32.1.1 and 32.1.2. So we have two parts to section 32, 32.1.1 and 32.1.2. Now, what are these two parts? Let's try and understand. So 32.1.1, which is there, is concerning the units which are into the power generation and distribution. Right? So 32.1.1, which is there, is in the case of the assets of an undertaking engaged in generation and distribution of the power. So, for the assessee, engaged in generation and distribution of the power. Are we clear? So, for them, what does section 32.1 says? Section 32.1.1 says, in case of an assets of an undertaking engaged, so here we may write not the assessee. The assessee will not be the correct term over here because it is undertaking. So an assessee may have undertaking which is engaged in generation and distribution of power. This is 32.1.1 says percentage of the actual cost. Percentage on the actual cost. So, which means here we are looking at straight line method. SLM. So here for the assets of an undertaking which are engaged in generation or distribution and generation and distribution of power, then percentage on the actual cost thereof. This is prescribed under, the percentages are prescribed under Rule 5(1)(a). Rule 5(1)(a), the percentages are prescribed. Are we clear? Now, this is not a mandatory scheme. This is an optional scheme if they want to opt for the SLM basis. Are we clear? So that is 32(1)(1). Are we clear? Now, we are looking for the time being only for 32(1)(1). 32(1)(2), we will be discussing this later, which is for the block of assets. So 32(1)(2) says that in case of the block of assets, percentage on the written down value as may be prescribed. So this is on the block of assets. And this is as per on the WDV, which is the WDV method. And the percentages are under Rule 5(1). Are we clear? Are we clear? Now, if you see the SLM method, which is for the undertakings in the generation and distribution of the power. Right? Now, for them, we are just looking at it first. If the asset is demolished, destroyed, discarded, sold, or transferred. If the asset on which we had claimed the depreciation on the SLM basis was discarded or sold or transferred, then two scenarios. Scenario number one, if my sale price is lesser than the WDV. And scenario 2 is if my sale price is greater than the WDV. Let's say my actual cost is 150. Let's say my actual cost is 150. Let's say the depreciation claimed is 50. And let's say the WDV is 100. Now, scenario 1, let's say the sale consideration is 60. Selling price is 60. Are we clear? Let's say the selling price is 60. Now, in that case, the selling price is lesser than my WDV. Selling price is lesser than the WDV, right? So here, what does 32(1)(3) says? 32(1)(3) says that in case of the assets on which the depreciation has been claimed under 3211, the amount of sale consideration or the money payable together with any scrap value, if any, falls short of the written down value, then the deficiency will be allowed as the deduction. Then the deficiency will be allowed as the deduction. So here my deficiency will be 40. This will be allowed as deduction under section 32(1)(3), which is also called as terminal depreciation. This is my terminal depreciation. Are we clear? So here I had assumed my sale price to be 60. Let's assume scenario 2. My selling price is say 150. So my selling price is greater than the WDV. Are we clear? Selling price is greater than the WDV. Now in that case, what does it say? That sale price, if it is greater than the WDV, then the surplus which is there, the surplus which is there, to the extent earlier allowed as a deduction under 32(1)(1), so out of 50, there will be the taxability of 50, which is earlier allowed as the depreciation under 32(1)(1). So the depreciation allowed earlier will be now taxable under section 41(2), which is called as balancing charge, which is called as a balancing charge. And any excess, is there any excess? The answer is no. Right? So is there any excess? The answer is no. So under 41(2), your balancing charge will be 50. Are we clear? So here there is no any excess in the surplus. So therefore only 50 will be balancing charge, which is taxable under section 41(2). Are we clear? So what does 41(2) says? Section 41 says that any depreciation which is claimed under section 32(1)(1), and now the asset is disposed of, then the amount of the sale consideration which is exceeding the written down value. So any money payable on the sale or disposal or discarding the asset. So if that exceeds the written down value, then the excess which was earlier allowed as the depreciation will be taxable or will be chargeable to tax as the income of the business in the previous year in which the money becomes due. Are we clear? So that will be taxable under 41(2). Now let's say if the sale price would have been 180. In that case, 50 would have been the balancing charge chargeable to tax under 41(2). The excess amount then would have been 30, right? Because surplus would have been 80 here. So, sale consideration, which is 150, less actual cost, which is 100. Sorry, sale consideration 180, actual cost 100. So then 80 would have been my surplus. From this, I would reduce 41(2), the balancing charge, which is 50. 30 would be my capital gain. 30 would be my capital gain. Are we clear? So 30 would be chargeable under the head capital gains. Any doubt? Yes, Samyak. Now did you understand what will happen if there is excess? So even if it would have been for 170, then 20 would have been under the head capital gain. Clear? This is under section 50A. So 50A says that where the capital asset is the one on which the depreciation under 32(1)(1) has been claimed, then in that case, the balancing charge will also be considered for the purpose of the cost of acquisition. Are we clear? Any doubt? Did you understand this? Okay. Now moving further, in the case of the block of assets. Now block scheme of depreciation. Now we are talking about the block scheme of the depreciation. Are we clear? Now, in this case of the block scheme of depreciation, this is what you have been learning all this while, right? So 32(1)(2) is the block of asset concept. Now, once it goes to the block, then the asset loses its individual color. Then the asset will lose its individual color. It will form the part of the block. And that's what we are going to look at now as to how the block of asset concept is functioning. So for that, let's try and understand how does it work and what are the kind of assets. So under the block scheme of assets, depreciation will be allowed on the following asset. So the block is of the following asset: tangible assets and the intangible assets. Now this particular block scheme is regulated by Rule 5. Mind you, by Rule 5, right? Now, under section 32, we have the tangible as well as the intangible assets. We have tangible as well as the intangible assets, right? So the block of assets will be under the tangible assets. We have building, plant and machinery, furniture, and fixtures. So building, plant and machinery, and furniture and fixtures. Now, what is the meaning of the building? Building will refer to any superstructures, right? Block of assets means, first of all, it is a group of two assets, the tangible and the intangible. This is defined under, or let me write it here, block of asset. This is defined under section 211. So tangible and intangible. Now building means any superstructure. It will include roads, any bridges, any wells or any wells, right? But it will not include the land. So land is not the depreciable asset. Then plant. Now what do we mean by plant? Plant is defined. Plant is defined under section 43. So plant is defined under section 43, which is a definition section for the PGBP head. So 43.3 defines the plant to mean plant includes ships, vehicles, books, scientific apparatus, and surgical equipments. And surgical equipments. It excludes the tea bushes, livestock, building, and furniture and fixture. Alright? So that is the meaning of the term plant, which is defined as I said. Are we clear? Any doubt? Yes, Samyak, the 3211 was only for the power undertakings. Clear? Now, what are the intangibles? So again, section 211 defines the intangibles. It doesn't define, it says what are the intangibles. Right, so for tangible, it had said building, plant and furniture and fitting for the block of assets. For intangibles, it says know-how, patents, copyrights, trademark, licenses, franchises, or any other business or commercial rights of similar nature. But it does not include goodwill. It excludes goodwill of business or profession. So this has been the recent amendment. Earlier there were decisions which had held that goodwill of a business or profession is eligible for depreciation. To override that, this legislative amendment was made, and therefore on goodwill of business or profession, no depreciation will be available. Are we clear? So these are the type of assets. Clear? So block of assets means what? That it has to be divided into only these 4 blocks. One, the building, second, plant, and the third is the furniture, and fourth is intangible. So it means the group of assets belonging to the same class of assets and where there is same rate of depreciation. Are we clear? So under the block scheme, you have the WDV and the depreciation which is there. Are we clear? So now how do we calculate or how do we compute the depreciation under the block scheme? So mode of computation of depreciation. Mode of computation of depreciation. So particulars and the number of units and amount. So let's say opening WDV as on 1st April of the previous year. You would make additions for greater than 180 days. Right? Additions for less than equal to 180 days. Less money payable on sale or asset discarded or demolished or destroyed, including the scrap value. Right? Then WDV of block as on 31st March of the previous year. Are we clear? So this is how your WDV is arrived at. Any doubt? Okay. So for the purpose of the computing the depreciation, this is how you would do your working. Clear? Now understand one thing. So the asset which is there, now this could be added and this could be reduced. But once it goes to the block, it forms part of the block. Clear? So we had saw how for the power generation unit, you have an option of going under the SLM, right? As per rule 51A. As per rule 51A. That is on the actual cost. And this is what we are following under the WD. Now, if the power generation unit wants to go for the WDV, it can go. If it wants to go for the SLM, it can exercise the option before the filing of the return of income. Are we clear? If it wants to go for this, it can go for this. So that is the optional scheme. The SLM base is the optional scheme. Generally, we have the block of asset concept. Clear? So now, as I said, that under the block of asset, you will have the different asset categories on which the same rate of depreciation is available. Clear? So now first we are going to look at the meaning of the WDV. First we are going to look at the meaning of the WDV. Let's try and understand that. So in case of certain assets, the WDV would be the actual cost. In case of certain assets, the WDV would be the notional cost also. So that's what we are going to learn now. What is the meaning of the term WDV? And for different assets, we will have different WDVs, right? Or different scenarios, we will have different meaning of the term WDV. Okay. So first, WDV to be arrived on the notional basis. So let's write down in this way. WDV. This is provided under section 43(6). So for newly acquired assets, this is, as I said, will be the actual cost. Actual cost is under section 43(1). Actual cost is under section 43(1). And for the previously acquired assets, and for the block scheme, sometimes we have WDV on notional basis, and sometimes it is even nil. Clear? So let's try and understand now. First, the WDV on the notional basis. As I said, 43(6) is what is talking about the WDV. So in case of the assets acquired, it is the actual cost. Under 43(6)(a). Are we clear? Then, in the case of the assets acquired previously, for that we may have the WDV, which is the actual cost less depreciation allowed, but sometimes it could be notional. That's what we are going to learn now. And in the case of the block of assets, for the block scheme, the WDV will be how it will be computed, as I said, in this particular manner, right? So this is the mode of the computation of the depreciation in case of the block of assets. You increase by the actual cost of the assets acquired during the year. You reduce the money payable for the asset which is sold or discarded. And then you arrive at the depreciation. Oh, sorry, at the WDV as on the last day of the previous year. Are we clear? Now, understand one thing. First, we'll talk about the notional basis. Clear? So, for the notional basis, where let's say the business person was not required to compute the business profits in the earlier years, but now is liable to income tax. Right? So person who was not required to compute the business profits earlier, but now is required to do that. Or in the case of, let's say, WDV in the case of succession of the business. So WDV in case of succession of the business, WDV in the case of the succession of the business. So the written down value will be the amount which had been the written down value in the hands of the predecessor. Are we clear? So amount WDV as it would have been in the hands of the predecessor. In the hands of the predecessor. Are we clear? Even in the case of the amalgamation, even in the case of the amalgamation, or in the case where block of asset is transferred by a holding company to a subsidiary company, to a wholly owned Indian subsidiary company, or by the subsidiary to the holding company, then in that particular case, the written down value in the hands of the transferee company will be the written down value of the transferor company. Are we clear? So, in case of amalgamation or transfer by holding company to wholly owned subsidiary or vice versa, right? Where conditions of 47, 4 and 5 are satisfied. We are going to learn this section in capital gain. Then, in that particular case, the block of assets for that, the WDV will be WDV of the transferor company or the amalgamating company. Are we clear? Similarly, in the case of the demerger, then the WDV in the block of assets of the demerged company will be the WDV of the resulting company. So WDV of the demerged company. Similarly, in the case of the balanced WD, so what happens in the demerger is, say in the demerger, when any asset which is forming part of the block is transferred by the demerged company to the resulting company, then the written down value of the block of assets of the demerged company will be reduced by the WDV of the assets transferred to the resulting company. And for the block of assets which is transferred by the demerged company to the resulting company, the written down value of the resulting company shall be the written down value of the demerged company. So see, the assets may get divided between the two because there was just one single block. Let's say there was this one company which has hived off its unit, right? So let's say there was company AB, it had a unit A, it had unit B. But at the block of asset, there will be just one plant and machinery which will be of A and B both, right? In the company AB. Now when it is hiving off the undertaking B, so the plant and machinery B which is there, which was in the block, the WDV of that particular plant B will be the WDV in the hands of the resulting company. But in the hands of the demerged company, you will have to reduce that WDV what you are transferring, and the balance will be the WDV which will be eligible for depreciation in the hands of the demerged company. Are we clear? So let's say, for example, if there was company AB which is transferring the unit B, but it had the block of asset, let's say plant and machinery. Now, some part of the plant and machinery is transferred to unit B. So, the WDV of the plant which is transferred of unit B will be the WDV in the hands of, let's say, company B. And the balance less WDV of asset transferred will be here in company AB. Are we clear? Any doubt till now? Okay. So, this is how the depreciation is there, right? Now, in the case of the block of assets transferred by a private company or unlisted company to a LLP on conversion into the LLP. We have a section under capital gain 47(13)(b), which is for the conversion of the private limited or unlisted company to the LLP. And if those conditions are satisfied, then the written down value of the block of assets of that particular company will be the written down value in the hands of the LLP. So, conversion of company to LLP, written down value of the block in hands of company. Are we clear? Any doubt? Okay. Now, in case of a person earlier opting for presumptive taxation and now opting for the normal scheme, or earlier he might have been exempt and now he is liable to tax, right? Then in that particular case, the WDV will be, so where an assessee was not required to compute his total income and now he is required to compute it. But he has an asset since many years. Let's say he has the building since many years. Now he is required to compute his income and he has a business income now. So actual cost of asset will be, so WDV will be the actual cost of asset as reduced by the depreciation, the deemed depreciation for those many years, and then the WDV will be computed. Are we clear? So, where person who is not required to compute total income and now liable to income tax and is now liable to income tax. So where the assessee was not required to compute the total income and now he is liable. So then in that particular case, WDV will be the actual cost minus depreciation deemed to have been provided in books of accounts. Are we clear? Similarly, it is for the case of person earlier opting for presumptive taxation and now under the normal scheme. So earlier opting for presumptive tax and now opting for normal scheme. Are we clear? Similarly, if it is a case that where the building was previously the property of the assessee and now is brought into the use for the purpose of business or profession. Are we clear? So let's say the building was earlier used for residential purpose. But now it has been, the assessee has started using it for the purpose of business or profession. Then in that case, the depreciation which would have been allowed to him, the WDV will be computed in that particular way. So, in case building not previously used for business, and now used for business or profession, then WDV will be the actual cost minus the depreciation notionally allowed since date of acquisition. And last case here, in case of the composite income. What is composite income? So, where let's say for example, the assessee has the composite income from agriculture as well as the non-agricultural income. So there is this rule 8 which provides that income derived from sale of tea grown and manufactured, in that case 40% of such income is only liable to tax, right? So let's say if the turnover of the assessee is 20 lakhs, the depreciation is 1 lakh, and some other expenses are, let's say, 4 lakh. So the profit is 15 lakh. Now, if that is the entire income from the manufacturing and sale of tea, then in that case, 40% would be the taxable income, which is 6 lakh. Right? In this particular case, if the depreciation was 1 lakh, so the courts had earlier held that the depreciation, which is also 40%, should only be allowed to compute the written down value. So therefore, there is an explanation 7 which has been introduced, which is providing that the entire 1 lakh has to be reduced to compute the WDV. So what does explanation 7 provides that? It says that the WDV, where the income of an assessee is partly from agriculture and partly is chargeable to business. So for the purpose of computing the written down value, the depreciation shall be computed as if the entire income is from the business of the assessee. So in case of composite income, then in that particular case, actual cost minus notional depreciation as if entire composite income is taxable. Are we clear? Are we clear? Any doubts? Capital gain, Biswaranjan, for the demerger, we will be looking into when we are looking at the capital gain chapter. Are we clear? That we will be dealing in when we are looking at the capital gain chapter. Any doubt till now? Okay. So this was the WDV in the case of the notional assets. Now, moving further, WDV, when is it nil? When we will have the WDV as nil. So, WDV will be considered as nil in the 2 cases. And what are those 2 cases? Let's try and understand. Where the money payable or money receivable in respect of assets sold or transferred or discarded, right? Plus the scrap value is greater than written down value. Is greater than the written down value. Is greater than the written down value plus the actual cost of the assets which are purchased in the current year. Then in that case, WDV will be considered as nil and the excess which is there, will be chargeable under the head capital gains as short-term capital gain under section 15. Second scenario is when all the assets in the block are transferred. All the assets in the block are transferred. So in both of these cases, the WDV will be considered as nil. So where all the assets in the block are transferred and the block ceases to exist. So even if the block will have some positive value, still the WDV will be considered as nil and the amount will be short-term capital loss. Short-term capital loss. Are we clear? So where the amount receivable is greater than the WDV plus the actual cost, then in that case, it will be short-term capital gain under section 50 and the WDV will be considered as nil. Are we clear? Okay. So let's take an example. Let's say, for example, if my opening WDV is say 5 lakh, actual cost of assets purchased during the year is say 2 lakh. Money payable is, let's say, 10 lakh for the assets discarded during the year. So in this case, closing WDV will be nil. And there will be capital gains, short-term capital gains. So sale consideration 10 lakh less WDV 5 lakh less actual cost 2 lakh. So my short-term capital gain will be 3 lakhs. Are we clear? So this is how it has to be computed. Any doubt? Clear? Also, we are going back again to the calculation of the WDV over here. This one. This, as I said, the WDV of the block of assets, first you have to start with the as on the 1st April 2022. As on the 1st April 2022, right? So that has to be considered. Less it will be increased by the actual cost of assets acquired during the previous year. This will not include the goodwill of business or profession. So here, goodwill of business or profession not to be included. Are we clear? So goodwill of business or profession is not to be included. Clear? Then reduced by the money receivable in respect of any asset, right? Falling within the block which is sold during the current year. Are we clear? So that will also be not considered over here. Oh, sorry, that will be reduced by. And then here one more addition you will have to make. Let's say if there is any slump sale during the year, which is what we are going to again discuss under the head capital gain. Then the actual cost minus the amount of depreciation that would have been allowable for any assessment year. If that particular asset which is transferred as a part of the slump sale, that particular amount has to be reduced. That particular amount has to be reduced. So here you also need to reduce less actual cost minus depreciation allowable on asset transferred in slump sale. On asset transferred in slump sale. Are we clear? Any doubt? Any doubt? Okay. Then we will be moving on towards the actual cost. The first part, right? The actual cost. This is very, very important. Section 43(1). So how do we determine the actual cost? Are we clear? Now, understand one thing. You have to add and you have to less certain things over here. Add purchase price plus all the expenses that are incurred to bring the asset into existence, or to put it in working condition. So section 43(1), which is there, section 43(1), which is there, if you read section 43(1), right, it says the actual cost means the actual cost of the assets to the assessee. So while defining the term actual cost, it says actual cost means the actual cost of the assets to the assessee. So how do we understand what is actual cost? So you have to understand as per the commercial understanding. So Supreme Court, in the case of Chellapalli Sugar Mills case, had observed that the actual cost is the cost which is not only the purchase price, but it includes all the expenses that are incurred to bring the asset into existence or to put it under working condition. So let's say if I'm buying a television, the actual cost is not just the purchase price, but the installation charges, the transportation charges, whatever I have incurred, to put that into the working condition. All those will form the part of the actual cost. Are we clear? All that will form part of the actual cost. So if you look at the ICDS 5, again we have started making the references to ICDS. Here, for the purpose of the actual cost, we are going to make a lot of references to ICDS. ICDS 5, which is for the tangible assets. What does ICDS 5 says? ICDS 5 also talks about the same thing. It talks about the same thing. So, for the purpose of the assets, it says that all the installation charges needs to be added. Right? So, tangible fixed asset is defined to mean land, building, machinery, plant or furniture, which is held with the intention of being used for the purpose of producing or providing goods or services. So it clearly says that expenses on trial runs, commissioning have to be added. Expenses on trial run or commissioning needs to be added. Are we clear? Next is, if you see the actual cost under 43.1, it provides for several explanations, which is for the purpose of clarifying the meaning of the actual cost. One such explanation there is for the interest amount. Explanation 8 to section 43.1. It says that where any amount is paid as interest in connection with the acquisition of an asset. So explanation 8 to section 43.1, it says amount paid or payable as interest. Amount paid or payable as interest in connection with the acquisition of the asset. Then the amount of interest after the asset is put to use will not be included in the actual cost. Meaning, interest paid up to the date when the asset is put to use will be capitalized. So explanation 8 to section 43.1 says that amount of interest which is in connection with the acquisition of asset after the asset is put to use will not be capitalized. Meaning, until the asset is put to use, it will be capitalized. So interest up to the date the asset is put to use will be capitalized. Clear? Similarly, if you go to section 36.1.3, which talks about the deduction of the interest. So it says that the 36.1.3 says that the amount of interest paid in respect of capital borrowed for the purpose of business or profession is allowed as deduction. But it has a proviso which says that the amount of interest paid in respect of capital borrowed for the acquisition of an asset for the period beginning from the date when the capital was borrowed till the asset which is first put to use will not be allowed as the deduction. Will not be allowed as the deduction. So, meaning thereby that till the time the asset is put to use, the interest on the capital borrowed will be capitalized. Interest on the capital borrowed will be capitalized. Are we clear? Now, in this context, we will again refer to the ICDS. Here also make a reference to section 36.1.3, interest on capital borrowed will not be allowed as deduction. Will not be allowed as deduction for capital borrowed for acquisition of asset will not be a deduction for period from borrowing till asset first put to use. Are we clear? Clear? Now here I am again making, as I said, the reference to ICDS 9. So here I am making a reference to the ICDS 9. Now, as I said, ICDS 9 is dealing with what? The borrowing cost. ICDS 9 deals with the borrowing cost. You don't need to read the ICDS in isolation. How you have to read it is in terms of linking it with the particular provision. Are we clear? So ICDS 9 which is there is in respect of the borrowings. So what does it say? It first of all talks about the borrowing cost. It talks about the borrowing cost, and borrowing cost, it says that these are interest and it includes commitment charges plus discounts or premiums, amortized amount of discount or premiums relating to borrowings. Are we clear? Plus, sorry, it also includes amortized amount of ancillary cost incurred in connection with the arrangement of borrowings plus finance charges in respect of assets acquired under finance lease. Not operating lease, but the finance lease. Are we clear? So what does it say? What does ICDS 9 talks about? So ICDS 9 again is dealing with the same thing. The costs which are directly attributable to cost directly attributable to purchase, construction, production, or manufacturing of qualifying asset. So it says the borrowing cost, which are where the funds are borrowed specifically for the purpose of acquiring, construction, or production of a qualifying asset, the borrowing cost will be capitalized on that asset. So borrowing cost will be capitalized on that asset. So borrowing costs that are directly attributable to the acquisition, construction, production of a qualifying asset shall be capitalized as the part of the cost of the asset. So it says borrowing cost which are directly attributable to the purchase or construction or production or manufacturing of qualifying asset are to be capitalized to the cost of asset. Now, what is the meaning of the qualifying asset? Qualifying asset they have included to mean land, building, plant and machinery, furniture, intangible assets, and inventories that require more than 12 months period to bring them to sellable condition. Greater than equal to 12 months to be sellable. So then it says it has to be capitalized to the cost of the asset. Are we clear? Secondly, it says that where the borrowing cost is not directly, so where borrowing cost is not directly relatable or directly attributable, where the borrowing cost is not directly attributable, then in that case, how we need to divide it? Then you have to capitalize on proportional basis. And how do you do that? A into B divided by C. Now, what is A into B divided by C? A is the borrowing cost. A is the borrowing cost. A is the borrowing cost incurred during the year. B is the average of the cost of the qualifying asset as on the first day and the last day of the previous year. So average of the cost of the qualifying asset. Are we clear? So B is average cost of the qualifying asset and C is the average of the total assets. Average cost of total assets. Average of the assets appearing as on the first and the last day of the previous year. Are we clear? And till when you have to capitalize? Till when you have to capitalize? From the date on which the funds were borrowed. From the date on which funds were borrowed. In this case, from date on which, or let me write capitalization period till the date when the qualifying asset is first put to use. Till qualifying asset is first put to use. Are we clear? And in this particular case, the capitalization period will be, since this is a general loan, right? So where the cost directly attributable to the purchase or construction, where the loan is borrowed for the purpose of acquiring, say, plant and machinery. But this is a case of your general overdraft or loan, where it is also borrowed for business purpose, plus some part of the loan is utilized for acquiring the asset. So in that case, the capitalization period will be the date from when funds were utilized, because funds may have been borrowed earlier for business also. But when you are utilizing it for the purpose of acquiring the asset, then date when funds were utilized till date qualifying asset is first put to use. Any questions, any doubt? Okay. So this is how your ICDS 9 talks about. So when it is a direct loan, which is for the purpose of acquiring asset, then you have to capitalize entire cost, which is what your explanation 8 to 43 1, 3613 proviso, as well as ICDS 9 is saying. So when in the exam you have been given this particular adjustment, you have to make a reference to all the three. Are we clear? When it is a general loan, which is for the purpose of business, as well as for some part is used for the acquiring the asset, then you have to do it on a proportional basis as per ICDS 9. A is the borrowing cost, B is the cost of the qualifying asset, and C is the average cost of the total asset. Are we clear? Any doubt? Okay. Also, again going back to the actual cost. So what all we have done till now? Purchase price plus all the expenses that are incurred to bring the asset into existence or to put it into the working condition. This will also include the pre-commencement expenses. Because these are the expenses which are done to bring the asset into existence. For example, your professional fees for, let's say, design and drawings, salaries paid for, let's say, the construction, right, or the erection of the plant. So all the pre-commencement expenditure will also get included. Are we clear? Any doubt? Clear? Okay. Next one is the foreign exchange loss or gain. Foreign exchange loss. So let's say loan is taken in foreign currency. Loan is taken in foreign currency for the purpose of purchasing the asset from, say, foreign country, right? From a foreign country. So for that purpose, what is the treatment? So we need to look into section 43A. Section 43A of the Income Tax Act talks about the foreign exchange losses on the asset acquired in the foreign currency. 43A says that where the assessee has acquired any asset from outside India, so imported asset, not the Indian asset, for the purpose of his business or profession, and in consequence of that, there is fluctuation in the rate of exchange. There may be increase, there may be decrease in the liability of the assessee, the loan amount which is there. Then the amount of the foreign exchange gain or loss which is there. Right? That shall be added to or reduced from the actual cost of the asset. That will be added to or reduced from the actual cost of the asset. So foreign exchange loss or gain, you will add or less as per section 43A, when it has to be done when it has to be capitalized when loan has been repaid in full or in part. So this has to be on the payment basis and not when the loan is due. Are we clear? So at the time of making the payment of the loan, partly or fully, at that time, whatever exchange gain loss happens, that will be added or reduced from the actual cost. Are we clear? Are we clear? So whatever where the assessee has purchased a foreign asset, so in that particular case, the rate of gain or loss, rate of exchange which is there, which is resulting in, there may be fluctuation in rate of exchange. So if there is gain or loss, that will be added or reduced, but when the loan has been repaid in part or in full. Are we clear? Any doubt? Any doubt? Okay. So that is section 43A. Now again here, I would be moving to the ICDS. But before that, I'll give you a small note here. So section 43A, loan in foreign exchange. Sorry. You have to capitalize the exchange gain or loss. So loan in foreign exchange plus asset acquired outside India. Asset acquired from outside India, then capitalize exchange gain or loss, and this has to be done in previous year, recognition in previous year in which loan is repaid in full or part. Are we clear? Yes, Aniket, importing asset. After this, we'll be making a reference to ICDS 6. But before that, we'll take a short break of 10 to 15 minutes. Is that fine? Let's take a break of 10-15 minutes and then we'll get back. Okay. So let's go ahead, students. As I said, I'll be discussing now about ICDS 6. So ICDS 6, treatment of foreign exchange rate fluctuation. Okay. Treatment of foreign exchange rate fluctuation. Now, even ICDS 6 talks in a similar way. Let's try and understand about that. Okay. So if you see ICDS 6, which is for the foreign exchange rate fluctuation, what does it say is that there will be 3 categories: for the non-monetary item, for the monetary items, and for the forward contracts. Okay. So it says that first we are talking about a non-monetary item. What is non-monetary item? Non-monetary items are assets and liabilities which are other than monetary items. So ICDS 6 talks about non-monetary item, or defines non-monetary item as other than the monetary item. And what are monetary items? Monetary items are money held and assets to be received or liabilities to be paid in fixed or determinable amounts of money. In fixed or determinable amounts of money. Example of monetary item: cash, receivable, payables, right? So non-monetary items are other than monetary item, which means your fixed assets, then your inventories and investment. So first, for the non-monetary items, it says how we have to recognize the foreign exchange rate fluctuation. How we have to recognize that? How we have to recognize the foreign exchange differences. So, in case of the non-monetary item, the exchange differences arising on the conversion. The exchange differences arising on the conversion shall only be recognized only at the time of the transaction. Recognition only at the time of the transaction. Are we clear? So, foreign exchange transactions shall be recorded on initial recognition only in the reporting currency, and by applying the foreign exchange currency amount, the exchange rate between the reporting currency and the foreign currency at the date of the transaction. So for the non-monetary items, you will not have any exchange differences recognized at the end of the year. That will not be recognized either as income or expenses. Are we clear? So in case of non-monetary items, you have to recognize you have to use the exchange rate as on the date of the transaction itself. Clear? For the monetary item, for the monetary items other than section 43A, how do we need to recognize? So exchange differences will be on mark-to-market basis. Recognition on M2M mark-to-market basis. Are we clear? So foreign currency, first of all, at the initial recognition will be by applying the exchange rate as on the date of the transaction. So that is how you will first initially recognize. And then at the end of the period, at the last day of each previous year, monetary items will be converted into the foreign exchange rate will be taken as on the last day of the previous year by applying the closing rate. So on mark-to-market basis, you will recognize the monetary item. Non-monetary item, as I said, you will not recognize any gain or loss as on the last day of the previous year. And then again on the settlement, the income or expenses will again be recognized based on the exchange rate as on that date. So for the monetary item, it will be on mark-to-market basis, meaning you will recognize as on the last year of the closing year as well as when you are settling it. Are we clear? Then finally, the forward contracts, the forward exchange contract. The forward exchange contracts. Now, the forward exchange contract means what? This is an agreement to exchange the different currencies at the forward rate and will include the option contract, right? So these are the forward exchange contract. Now, in respect of the forward exchange contract, how do you need to recognize it? So, if the contracts are for the hedging purpose, if the contract are for the hedging purpose, in that particular case, the exchange difference will be recognized on a pro rata basis. Exchange difference meaning what? The forward rate minus spot rate. Recognized on pro rata basis, recognized to P&L on pro rata basis over life of the contract. So any premium or discount arising on the forward exchange contract will be amortized as expense or income over the life of the contract. And this will be recognized again on the mark-to-market basis, as in when the exchange rate is changing. Are we clear? If it is for the speculation purpose, then in that case, if this is a speculation purpose, if it is for hedging, then you have to amortize the exchange differences or the premium or discount over the life of the contract. Are we clear? And If it is for the speculation purpose, then in that particular case, how would you recognize it? The exchange difference will be charged to P&L. Charged to P&L only on settlement of contract. Only on settlement of contract. Are we clear? So, premium or discount that is arising on the contract, exchange difference, whatever is arising, that is, which is the premium or the discount, will be on the settlement date. Are we clear? Shall be only recognized at the time of the settlement. Is that clear? Any doubt? And the balance on the asset which is imported from foreign currency, on the asset which is imported from foreign country through a loan borrowed in foreign currency, that will be as per 43A. Any doubt? Are we clear? Fine. So this we have finished the add side of it. So what we were discussing, don't get lost, we were discussing about the actual cost. Actual cost is defined under 43(1) to mean the actual cost to the assessee, which means what? As per Challapalli Sugar Mills Limited case, purchase price plus all the expenses that are incurred to bring the asset into the existence or to put it in the working condition. This will include even the pre-commencement expenditure, trial runs, which is as per ICDS file, interest on the loan taken for acquiring the asset, till the time the asset is put to use, that will be capitalized. As per explanation 8 to section 43(1), proviso to section 36(1)(3) and ICDS 9. Are we clear? So whatever is the specific borrowing, for that you will capitalize the entire cost till the asset is put to use. If it is a general borrowing out of which some funds are utilized for purchasing the asset, then you will take the borrowing cost into the average of the qualifying asset divided by the average of total asset. You will add or less the foreign exchange gain or loss on the asset which is imported and bought through the foreign currency loan. Then when you repay the loan, only on the payment of the loan, either in full or part, the exchange difference will be capitalized. Are we clear? Is this much clear? And then we have discussed about the ICDS 6. So we have, okay, hedging is confusing. I'll explain it again, Aniket. So if I have purchased the forward exchange contract for the purpose of hedging, so sometimes we purchase the forward exchange contract in order to insulate the foreign exchange gain or loss which is arising, or to avoid any fluctuations in the asset, right? I am purchasing for the purpose of hedging. So in that case, the exchange difference is to be amortized on the pro rata basis over the life of the contract. If I am purchasing the forward exchange contract for the speculation, then it has to be on the exchange difference will be charged to P&L on the settlement of the contract. Are we clear? Now, I'm moving towards the less. This side, right? So number one, any trial run income. So number one, any income which may arise to me. Let's say there is some production during the trial run and which I have sold. So any income may arise to me, so that I will have to reduce. Are we clear? Next is less any cost met directly or indirectly, by any other authority. I have been granted some subsidy, or there is waiver of the bank loan. So where, say for example, the loan was taken by the assessee to acquire the asset, and subsequently the bank has waived the loan, meaning I don't need to pay the loan anymore. Then the waiver of the loan will be reduced from the cost of the asset, right? As per section 43(1). So waiver of the bank loan. Are we clear? SENVAT credit. Any SENVAT credit we have claimed, that has to be reduced. Right? So under 43, I have the actual cost defined as, if you read the definition of the actual cost, it says actual cost means the actual cost of the asset reduced by the portion of the cost which has been met directly or indirectly by any other person or authority, and therefore we can reduce the waiver of the bank loan. SENVAT credit which is claimed, that can be reduced, right? So any cost which is any actual cost of asset will be reduced by the amount of the any SENVAT credit which is claimed. Clear? Next, portion of the cost of asset that has been met directly or indirectly by the central government or the state government in the form of subsidy, grant, or reimbursement. Explanation 10 to section 43(1). So where the portion of the cost of the asset, let's say for example, if I have received the subsidy or grant or any reimbursement from the government, then in that case, explanation 10 to section 43(1) says that has to be reduced from the cost of the asset. Again, for that purpose, we would refer to the ICDS. You can make a reference above only. Okay, I'll just make a reference here and then I'll write it below. So here, ICDS 8. Government grants. ICDS 8, the government grants. We are making a reference to that. So what does ICDS 8 talks about? Sorry, ICDS 7, not ICDS 8, ICDS 7, it should be government grants. Eight is for the securities. ICDS 7, government grants. Now what ICDS 7 talks about? It talks about the recognition of the government grants. So government grants are some of the assistance by the government either in cash or kind, right? For giving impetus to the particular industry. Now, when will be the recognition? When the government grants are to be recognized. So recognition, when there is reasonable assurance that you have to recognize the government grants when there is reasonable assurance that the person will comply with, when the person will comply with the conditions attached to the grants. Conditions attached to the grant. However, a recognition shall not be postponed beyond the date of actual receipt. So, when there is reasonable assurance that the person will comply with the terms and conditions attached to a grant, only then you will recognize. Let's say, for example, these government grants usually come up with certain conditions attached to it. Let's say the government will give the grant that only when you will complete this project, these grants will be granted to you, right? Or these grants are granted to you only when you would be able to finish off this particular project. Let's say a person is working on a building site. That building site is based on the government grants. Now, if he is not able to, if there is no reasonable certainty, there is no reasonable assurance that the building will get completed, because let's say there has been some stoppage there because of some political turbulence, then in that case, you will not be able to recognize that. But when you are nearing to the completion, you will recognize when there is reasonable assurance that the person will comply with the conditions, then the government grants will be recognized. However, if it has been actually received, then the recognition will not be postponed. Let's say I have received the government grants, but let's say I have not been in a position to ascertain that whether I will be able to comply with the conditions. Still, I will have to recognize because I have the actual receipt of the government grants. Are we clear? So that is about the recognition. And what is the treatment? What will be the treatment? So the treatment depends on the type of the grant, right? So if the grant is relating to a depreciable fixed asset, if it relates to depreciable fixed asset, the grant will be reduced from the actual cost of the asset. Reduce from actual cost of asset or from the WDV, right? So this is what even your explanation 10 or your main definition of 43(1)'s actual cost says that any assistance or the portion of the cost that has been met directly or indirectly by the any other person or met by the central or state government in the form of subsidy, then that shall be reduced from the cost, actual cost of the asset. Are we clear? And where it relates to a non-depreciable asset, where it relates to the non-depreciable asset, non-depreciable fixed asset, then in that case, the recognition will be, grant will be recognized as income over the period over which the cost of the meeting such obligations is charged to the income. Are you getting that? So let's say if I have land or if I have any other asset, like let's say for example, there are investments or any other asset which is not depreciable. So then in that case, that will be recognized as income over the period over which I have the expenses for meeting the obligations. So in case of non-depreciable fixed asset, the recognition will be the treatment of the grants will be, the grant shall be recognized as income over the period over which cost of meeting obligations is charged to income. Are we clear? Are we clear? Then, if the grant is for financial support, if the grant is for the financial support, if the grant is for the financial support, that is, it is receivable as compensation for expenses or for losses incurred or for the purpose of giving some financial support to a person, that shall be recognized as income of the period in which it is receivable. Recognized as income of the period in which it is receivable. Recognized as income of period in which it is receivable. Example of this could be power subsidy, transport subsidy. Are we clear? And let's say where, for example, the grants are given in the form of asset in kind, then they shall be accounted on the basis of their cost. So grants in form of non-monetary asset, you will recognize on cost, on their acquisition cost. Are we clear? Any doubt? Clear? And where, say, for example, the grant which is received, it cannot be directly relatable to the asset acquired. Because let's say, for example, I have received a total grant from which I have also acquired the asset. I have certain expenses also. So then in that case, the amount which bears to the total government grant, so the cost of the asset into the grant which is there divided by grant which is received divided by the total assets. So that will be the grant which I will recognize in front of a particular asset because it cannot be directly related. Are we clear? Any doubt? Any questions? Any questions? Any doubt? Okay. So is this clear? Actual cost, WDV? Is this clear? Okay. Last one thing in respect of the grants. If, say, for example, the grants are refunded. If, let's say, for example, the grants are refunded. So where, say, for example, the amount is refundable in respect of government grant. Right? So in case the government grant was in respect of the non-depreciable asset or for the financial assistance, right? Then that shall be, the refund shall be first applied against any unamortized amount which is there. So if you see for the non-depreciable fixed asset, how did we recognize the grant? So the grant was recognized by recognizing as the income over the period over which the cost is charged. Right? So any unamortized amount which is remaining in respect of the government grant, that the refund shall be first utilized against that. And the excess which is there, the amount which is excess against the credit which is lying in the balance sheet, that shall be charged to the profit and loss account. Because that had been earlier recognized as income, now you will recognize it as an expense to nullify it. Are we clear? In case of the government grant relating to the depreciable asset, if the amount is refunded in respect of the government grant for the depreciable asset, then the adjustment will be made in the actual cost. And the revised depreciation then will be computed. Are we clear? So if it is refunded, then in case of the, you can write it down, refund of government grant for non-depreciable fixed asset. First, adjust the refund against the unamortized amount and excess balance of refund charged to P&L. Clear? In case of depreciable fixed asset, then increasing the, because earlier we had reduced the actual cost. Now increasing the actual cost or WDV by the amount refundable and depreciation charge, depreciation on revised WDV or actual cost. Are we clear? Any doubts? Is this kind of mechanism clear to you, how we have done WDV, actual cost? I'll quickly revise to summarize everything for you before we proceed further. So where did we start today? It's very important to consolidate, right? We started with conditions for claiming depreciation. What are the conditions? Quickly revise with me. What are the conditions for claiming depreciation? It should be owned by the assessee. Lessee is not the owner. Who is the owner? Lessor. Exception to that is explanation 1 to section 32(1), where it says that building which is taken on lease, but I have done substantial amount of renovation or extension to the building. I have incurred the capital expenditure on extension or renovation. Then on that particular extension renovation, lessee will be entitled to depreciation as if the structure was owned by him. In case of hire purchase, if I would be able to if the asset will eventually be purchased by me, then the depreciation will be entitled to the the lessee is entitled to the depreciation. Clear? Second condition, condition 1, asset owned by the assessee. Second condition, asset used for the business or profession of the assessee. Even passive use is fine. Are we clear? Then we have come for the basis of the depreciation. Basis for the depreciation 32(1)(1) is in respect of the power generating and distribution units, which is as per the SLM, and 32(1) is for the block of assets. For the 32(1)(1), we have the concept of the terminal depreciation. where the selling price is less than the WDV in case the asset is disposed of. In terminal depreciation, you will charge the loss to the P&L. If my selling price is exceeding the WDV, then to the extent earlier depreciation claim, that will be taxable under 41(2) as balancing charge. Over and above that, under section 50A, under capital gains. Are we clear? This much clear? 32(1)(2) block of assets. Concept of WDV. Block of asset means tangible, intangible. Plant and building and furniture, right? Intangibles, we have copyright, patents, trademarks, any other business or commercial rights of similar nature, excluding goodwill of business or profession. Plant does not include livestock, bushes, and building furniture, right? It includes what? Ships, books, scientific apparatus, and vehicles. Then we have the mode of computation of the depreciation. WDV under 43(6). WDV, actual cost in case of newly acquired assets. WDV for the previously acquired assets to be computed as WDV as on the previous year, first day of the previous year, add the actual cost of the newly acquired assets, less money payable for the assets discarded, and that will be your closing WDV. WDV will be also a notional basis in case of certain assets. What is that? In case of succession of business, in case of amalgamation, in case of demerger, in case of conversion of company to LLP, WDV of the previous owner, where the person was not liable to tax or his first time being assessed to tax under the PGBP, he was under presumptive, or where he had the building which was used for the personal purposes but now is brought under the business, then the notional depreciation will be calculated as from the date of the acquisition. And in case of composite income, where partly the income is agriculture and partly it is for the business, then the depreciation will be, WDV will be as if the depreciation is on the entire asset, right? And not on the part basis. Are we clear? So let's say if the asset was of depreciation was 1 lakh, then not 40% will be reduced from WDV, but entire 1 lakh will be reduced as if the entire composite income was taxable. Clear? WDV will be nil when the selling price exceeds the WDV. Then in that case, there will be short-term capital gain under section 50, or when the entire assets are transferred. If the entire assets are transferred, there will be short-term capital loss. What is the actual cost of the assets acquired during the previous year? The purchase price plus whatever cost expenses are incurred to bring the asset into existence as per Chellapalli Sugar Limited case. This includes even the pre-commencement expenses. You have to add the trial run expenses. ICDS 5, it says trial run expenses have to be included. Trial run income has to be reduced. Then interest on the assets, interest on the capital borrowed for the assets purchased, you have to capitalize till the date of the asset first put to use. As per explanation 8 to section 43(1), as per proviso to section 36(1)(3), and as per ICDS 9. Right? If it is a general borrowing, A into B divided by C. A is your interest expense, B is your cost of the average cost of qualifying asset divided by average cost of the total assets. Then you have the also foreign exchange gain or loss on the imported asset where the loan was borrowed in foreign currency. Only when you repay the loan as per section 43A, that exchange loss will be recognized to the asset. It will be capitalized. Are we clear? That is as per 43A. Then we had done the ICDS 6, which is treatment of foreign exchange. On the non-monetary item, you recognize only at the time of transaction. On the monetary item, you recognize on M2M basis. On the forward exchange contract for hedging purposes over the life of the contract. On the forward exchange contract for speculation purpose, only on the settlement. Then for the less, we have to do the any cost met directly or indirectly by any other authority. Example, waiver of bank loan, SENVET credit, portion of cost that has been met directly or indirectly by central government. Explanation 10 to section 43(1) as well as ICDS 8. So ICDS 7. ICDS 7 says that in respect of the depreciable fixed asset, reduce the cost which is met directly or indirectly by the central government or state government. In respect of the non-depreciable fixed asset, charge it as income, recognize it as income over the cost of meeting the obligations. And in case of the financial assistance, you have to recognize it as income. Recognition only when there is reasonable certainty of the conditions which are to be complied with, but it shall not be delayed more than the actual receipt of the grant. Are we clear? Is this consolidated understanding clear? Yes or no, quickly in the chat box. Are you with me? Okay. Last one thing in the less part. Last one thing. Cash purchases greater than 10,000. So, where the assessee has incurred expenditure for the acquisition of asset for which the payment or the aggregate of the payment exceeds 10,000 rupees, then in that case, that amount will not be allowed. That amount will not be allowed to you, right? So in case where the expenditure is there for which payment or aggregate of payment is made to a person in a day exceeding rupees 10,000 other than by account, pay, check or draft or electronic clearing system such as credit card, debit card, RTGS, right? Then the expenditure shall be ignored while determining the actual cost, and you will not be able to claim the depreciation on that amount. Are we clear? Any doubt? Any doubt? Any questions? Any doubt? Are we clear about this? So actual cost, if you have any asset which is more than rupees 10,000, which is purchased in cash, right? So the second proviso says that if you have any asset which is more than rupees 10,000 purchased in cash, then that will be ignored from the actual cost. Second proviso to 43(1). Are we clear? Okay. Shall we proceed further then? So this was about the WDV. Now, we have not even touched on depreciation. If you see, we have not even touched on the rates of the depreciation. What are the rates of the depreciation? Now we have to see that. Okay. So, we have talked about the actual cost WDV, but what is the rate of the depreciation for the purpose of computation of the depreciation? Rates, as I said, are given under appendix as to the rule 1. Rule 5. So for the power generation, it was rule 5(1)(a), and for the normal assessees, it is under rule 5, right? So rule 5(1). Clear? So what are the rates of the depreciation? What are the rates? You know more than me, isn't it? So in case for the buildings which are used for the residential purposes, 5%. The buildings which are used for the commercial purposes, it is 10%. And in case of buildings, in case of furniture and fittings, it is 10%. Plant and machinery in case of the motor cars, 15%, right? In case of aeroplanes, aero engines, 40%. Other than that, plant and machinery is 15%, right? Life-saving medical equipments, 40%. Computers, 40%. Books, 40%. Ships are at 20%. Intangibles are at 25%. Remember one thing, mobile phones and EPBX are not considered as computers and are not entitled for 40%. While printers, scanners are eligible for 40% rate. Are we clear? So that is about the rate of the depreciation. Now, last one thing under the depreciation is the additional depreciation. additional depreciation. So additional depreciation, and then we have to do some for the actual cost. Few cases under the actual cost and the additional depreciation. Let's do first few cases under the actual cost. Few cases are left under the actual cost. That let's take that up first, which are very small cases. So in case where, say for example, the asset used for business after it ceases to be used for the scientific research. So when an asset is used now for the purpose of business, which is transferred from the asset which was earlier used for scientific research, then the actual cost will be, for the depreciation, the actual cost will be the actual cost as reduced by deduction allowed under section 35. So actual cost of asset transferred to business from scientific research use, actual cost minus deduction under section 35(1)(4). Are we clear? So it will be in a way nil because 100% deduction is allowed. Clear? Inventory converted into a capital asset and used for the purpose of business or profession. 28(6). Remember last lecture we had done this? So if you remember this, under PGBP we had done 28(6). This one. Right? Inventory converted into capital asset. This is not stock and trade. This is capital asset. Inventory converted into capital asset. So we had seen that the taxability under 28(6)(a) will be FMV as on the date of conversion. And when the inventory is sold, then capital gains, wherein the cost will be the FMV, which is taxed under 28(6)(a). Correct? But what if the meantime the inventory is used for the business or profession? So in that case, inventory used for, inventory converted used for, you can write it like this. Inventory converted into capital asset used for business or professions, and for the purpose of depreciation, what will be the cost? The actual cost will be the fair market value on the date of its conversion as charged under 28(6)(a). So this will be my actual cost. This is explanation 1A. Explanation 1A to section 43. Explanation 1A to section 43(1). Are we clear? So if it is for the purpose of business or profession use, then the actual cost will be the FMV, which is under 28(6)(a). Same will be under the capital gains also when it is sold. But if it is used for the purpose of depreciation, depreciation will be charged on this. Clear? Are we clear? Then if the asset is acquired by way of gift or inheritance, when an asset is acquired by way of gift or inheritance, The actual cost to the previous owner minus depreciation allowable to the assessee, as if the asset was the only asset in the books. So in case of this, we are talking about the actual cost only, right? Asset acquired by way of gift or inheritance. Gift or inheritance. When an asset is acquired by way of gift or inheritance, actual cost to the previous owner, actual cost to the previous owner okay, actual cost to the previous owner minus the depreciation allowable to the assessee less notional depreciation less notional depreciation. Are we clear? Then let's say if it's a second hand asset. So where before the date of the acquisition by the assessee has acquired, let's say, a second hand asset. Then for the second hand asset, if the assessing officer is of the belief is satisfied that the main purpose of the transfer of asset was for the purpose of reduction of the income tax liability by claiming the depreciation on the higher cost, then second hand asset acquired if AO is satisfied that the main purpose of acquiring asset was to reduce tax liability, then the amount which the AO may determine. Amount determined by AO with approval of JCIT. These could be questions for MCQ also, hence I am covering that here, right? Are we clear? Reacquisition of asset. Reacquisition of an asset. So let's say where an asset which had acquired, which had once belonged to somebody else, and or let's say for example where an asset had once belonged to me and I had used for the purpose of my business or profession, and then I have transferred it to somebody else and again I'm reacquiring it. Are we clear? So first I was owning the asset, then I'm transferring it to my friend, and then again I'm repurchasing it from him. Then the actual cost will be the actual cost when asset first acquired minus the depreciation on notional basis, as if the asset was the only asset, or price paid to reacquire whichever is less. So lower of actual cost when asset first acquired minus depreciation, or the price at which the asset is reacquired. Are we clear? Next is acquisition of asset previously owned by any person. Okay, so let's say this is a case of sale and lease back. This is a case of sale and lease back. So let's say Mr. A, let's say where Mr. A is there and then the Mr. B is there who was using the assets. And Mr. B had the assets with him. And he had claimed the depreciation also on such assets. Now Mr. A is taking the assets from Mr. B and then again leasing back to Mr. B. So let's say that Mr. A is purchasing the assets from Mr. B and then again giving those assets on lease to Mr. B. So what will happen in that scenario? So when I am taking the assets on lease, so initially I would have claimed the depreciation. Now I'm transferring the asset to A. A will claim the depreciation because owner is entitled to depreciation and not the lessee. But I will be able to claim I am Mr. B. I will be able to claim the lease rentals. Right? So that is a case of tax avoidance, isn't it? So for that purpose, they say that the actual cost will be actual cost in the hands of Mr. A. So actual cost will be to Mr. A will be written down value at the time of transfer by B, so that Mr. B does not manipulate the price. So if B owns an asset and he has claimed a depreciation and now is transferring to A, and then again A is giving on lease to Mr. B. So let's say sale to A, lease to B. This was the asset of B initially. So the cost to A will be WDV to B. Are we clear? Are we clear? Any doubt? Any questions? Any doubt? Any questions? Any doubt? Plant and machinery 15%. Yes, Aniket. Furniture 10%. Correct. Any other question? Okay. Now, last one thing is the additional depreciation, right? We are talking about now the additional depreciation. Let's discuss about that. Additional depreciation 30 to 1 way. Right? 30 to 1 to way. Additional depreciation. Now, how the additional depreciation is done? So, this is done to give an impetus to the manufacturing sector. For that purpose, we have the additional depreciation under section 31 to 1 2A. Right? Now, it's in respect of the additional depreciation, What is the additional rate of depreciation? It is 20% of the actual cost. Additional depreciation is 20% of the actual cost. So this is 20% of actual cost. Right? Now, eligible assessee. Eligible assessee for the additional depreciation is the assessee which is engaged in the manufacturing. Assessee engaged in the assessee who is engaged in the manufacturing of the business is entitled for the additional depreciation under 31(2)(a). Are we clear? So, this is, as I said, to give an impetus to the manufacturing sector, and therefore for that purpose we have additional depreciation under section 31(2)(a) on the manufacturing of the goods, right? It also includes the printing and publishing. Manufacturing will also include the printing and publishing, right? Manufacturing, there was a CBDT circular. It includes printing and manufacturing, right? So where the assessee has acquired a new plant and machinery other than ships or aircrafts, right? And assessee is engaged in the business of manufacturing or production of any article or thing, or in the business of also, this is also available on business of generation and distribution or transmission of power. Are we clear? What are the eligible assets? Eligible assets, plant and machinery. What are the ineligible assets? Second-hand plant and machinery. Second-hand plant and machinery. Office appliances. Office appliances or road transport vehicles. Plant and machinery used in residential or office premises. Plant and machinery which is allowed as deduction. Plant and machinery whose whole cost is allowed as deduction. Let's say under section 3580. Example under section 3580. Are we clear? So this additional depreciation is over and above the normal depreciation. So let's say, for example, if the computers are used in the office premises, on that they will not get any additional depreciation. But if it is used, let's say, in the factory premises, then you may be entitled for the additional depreciation. Are we clear? Also, additional depreciation will not be available if you have exercised the option under the optional scheme under section 115 BBA or BAB. We had done that, right? 25% and 15% and 22%. So if you're going under the optional scheme, or even for the cooperative society under 115 BAD, you will not be entitled for the additional depreciation. Are we clear? So additional depreciation will not be allowed in that particular case. Any doubts? Yes, Aniket, he cannot claim he can claim the lease rental. It's not about not claiming the lease rental in case of sale and lease back. The point is that what will be the actual cost in the hands of Mr. A. Clear, Aniket? Okay. Now, last one thing in the depreciation is the proportional depreciation. Last one thing is the proportional depreciation. So proportional depreciation is allowed in the case if the, okay, one more thing in the additional depreciation, if the assets are put to use for less than 180 days, asset is put to use for less than 180 days, then this will be 10%. But balance 10% will be carry forward claimed in the next year. Are we clear? Similar is the case with the normal depreciation. If it is put to use for less than 180 days, then only half of the depreciation is allowed, but that cannot be carried forward. This can be carried forward to next year because this is an incentive provision. Clear? Now, proportional depreciation, if let's say, for example, the asset is acquired and put to use, right? And then let's say, for example, there is conversion of the firm or sole proprietary into company or private limited or unlisted public company to LLP, or in case of amalgamation, or in the case of demerger, then the depreciation, the total depreciation allowable to the predecessor or to the successor company will be apportioned between predecessor and successor company based on number of days assets were used by them. So in case of conversion of the firm or sole proprietary into a company or private limited or unlisted public company to LLP or amalgamation or demerger, the total depreciation which is there, first the total depreciation will be computed as if there is no conversion or there is no amalgamation or demerger, and then the depreciation will be apportioned between the two, between the predecessor and the successor company based on the number of days the assets are used by them. Are we clear? Are we clear? Any doubts? Any question, any doubt? Okay. Last one thing, carry forward and set off of the depreciation. Of unabsorbed depreciation, section 32(2). So if the profits and gains are insufficient to absorb the depreciation allowance, the unabsorbed depreciation shall be deemed to be the depreciation of the next year. It will become the depreciation of the next year. and therefore it can be carried forward indefinitely until it is fully set off. So where there is unabsorbed depreciation, it will become the deemed depreciation of the next year. It can be carried forward and set off unlimited for unlimited period or indefinitely. But the order of the set off, the effect shall be first given to the current year depreciation, then the brought forward losses, and then the unabsorbed depreciation. So order of set off, first current year depreciation, then business loss brought forward because that will expire in 8 years, and then the unabsorbed depreciation, UAD. Are we clear? The unabsorbed depreciation can be set off against any head except salaries, since it becomes the current year depreciation. So indefinitely and can be set off against any other head except salaries because it becomes the current year depreciation, because it is deemed to be the current year depreciation. Are we clear? Any doubt? Any questions? Any doubt? Yes, Aniket, 20% of this year and 10% of the last year. Jacob, unabsorbed depreciation means, let's say for example, I have the depreciation allowance this year of say 8 lakhs. And my business profits are, let's say, only 6 lakh. So then 2 lakh is the unabsorbed depreciation which I can carry forward to the future years, and this will be deemed to be depreciation of next year. So I can carry it forward indefinitely and can set off against any other head except salary. But when, let's say for example, let's say this in the next year, my PGBP is say 15 lakh. And let's say I have brought forward business loss of 2 lakhs. I have depreciation of current year, let's say 10 lakhs, right? And unabsorbed depreciation of 2 lakhs, right? Or let's make it 13 lakhs. Depreciation of current year, let's say 13 lakhs. One second, let me just make it. Depreciation of current year, let's say 8 lakhs, right? And the brought forward business losses are, let's say 6 lakh. So in this case, for the next year, the order of set off will be 15 lakh minus first the depreciation of current year 8 lakh minus the brought forward business loss of 6 lakh, right? So this will give me only 1 lakh I can set off unabsorbed depreciation and balance carry forward. Are we clear? Jacob, did you understand? Bhavin, did you understand hedge? Hedge means that I'm trying to protect the fluctuations which are going to happen in the case of the purchase of any commodity in foreign exchange. So I purchase the forward exchange contract for hedging that. Okay. So what I want you to do is before your next class, try to solve the sums from the module in on the depreciation so that we can discuss in the next class, and that will become very quicker. So I expect you to do that and revise this very thoroughly. Thank you so much. See you in the next class.